Welcome to the daily stock review of Datadog. The goal of this channel is to uncover the world's best stocks that have 100x potential by reviewing 1,000 stocks in 12 months. If that sounds good, subscribe to come along. Who am I? I'm Jack. I'm an individual investor on the journey. I'm just 2,500 hours in over the last 7 years. I'm sharing lessons along the way. Here's my investing process. It's got 5 steps. Today we'll cover how I came across this stock and then the 5-minute check to see if it's worth looking into further. These are the guys I learn off. They did pretty well for themselves over just a little while. By following the breadcrumbs that they've left behind, should be able to follow in their footsteps. If you like the free resources, I wish I had when I first started out, calculators, checklists, etc. There is a link in the description and it's all for free. Alright, let's crack in. So Datadog. Came across this stock because there's a fair bit of hype around it at the moment and found it in some news coverage. So as you can see, it's pretty much doubled, pretty much more than doubled in its price in the last couple of months. So you can imagine why there's a bit of hype around it. Now, the annual report dropped on May 15th. Majority of this jump appears to have happened about a week earlier. So I'm not going to read into too much more of the timing and things like that. I just want to see some results. So in this annual report, this is part of the 5-minute check. What I want to find is the financial statements. And they're not linked, which is fine. What I want to do is have a look through these, analyze the trends that we can see in the business, and then make a bit of a decision around, has the business mastered its customer? We should be able to see that in terms of really strong revenue or revenue growth. Then want to have a look at the margins of the business, because that's where we can see if there's a bit of a moat around the business. And we should be able to see that in the financials. Next is we want to see management. We want to see if management are rational and they're spending the money in the business appropriately. We see them spending it pretty frivolously. That's usually a bad sign of over the long term, management have a very big impact on the success or the failure of the business. All right, so we're going to have a look at the income statement. It's also called the statement of operations. I've got revenue here back to 23, 24, and then 25. You can see it's gone from 2.1 billion, 2.7 billion, and then 3.4. So that is a pretty down good growth rate. That is pretty much going to be a double in 4 years if we go by that. And a little bit more. Now, the cost of revenue hasn't gone up that quickly, which is a good sign. That means our margins are expanding a bit as well. And they look pretty healthy. So that is a very high gross profit compared to revenue. So that's awesome. This is a very profitable business on that first part in terms of delivering the actual product. Doesn't cost very much. Now, it is spending a lot of that money in research and development, sales and marketing, and general and admin. So for a business with that kind of revenue and this kind of growth, I would be expecting the business to be very busy expanding its product, so research and development, and sales and marketing. So it's good to see that they are growing very quickly. Now, general and admin, and usually we don't like just seeing costs that aren't going to add to the business. So general and admin, sure, you need people to be able to allow the business to function, but we want to make sure this is growing in at least lockstep with the amount of gross profit that the business is making. All right. Operating loss income. So with all that spend up front on research and development, sales and marketing, etc., they've made a loss. But our net income is here. So how have they turned that operating loss into profit? All right, interest expense, interest income, and other. Okay. So getting a fair bit of money from interest income and income before provision for taxes, pay some tax, and their net income is positive. All right. So that looks like they're just trying to maintain some float. They're spending every cent they're getting at this stage in these buckets, grow the product, and then get the product in the hands of its customers. And it seems to be working pretty well with that revenue growth. All right. Net margins are obviously a lot smaller and a lot thinner. It does look like the majority of that money is getting spent to grow the business. All right, let's have a look at the balance sheet. So in terms of mastery, pretty happy there. And moat, yep. Depending on what business you're looking at, you obviously want to make sure they're spending it wisely. And so you could be happy with no net income or no, free cash flow as well if it's being spent appropriately. All right. Here I'm just looking for just some obvious stuff that they're not loaded up with too much debt. So total assets, 6.6 billion. Total liabilities, 2.9. Easy. Pardon me. All right, so that's pretty good. Let's go and have a look at the cash flow statement. So what our net income, and remember they're spending everything, so there's nothing really there, and it is a bit lumpy. So as these come out, we get our net cash provided by operating activities, and it appears to be growing, which is great. But mate, God, I've got a cold. If you haven't noticed thus far, all good. Just tickling the throat and it's a pain in the ass. All right, so 700, around 700 million. 870 and then 1 billion in net cash, which is pretty good. Purchases of marketable securities, sales of them. So they're just balancing that. That's where they grab some of that cash flow from. Purchases of property, plant, equipment. So a very small number pretty much compared to the amount of money that they're bringing in. Capitalized software development costs. So when we're looking at the free cash flow, we want net cash from operating minus capital expenses. So that would be this one, as well as software development costs. So we've got to take that into account when we do that. And what I kind of look for is the moat maintenance. So like, what are the parts of property and equipment and the capitalized software costs that is actually just to maintain the business? So that gives us a bit more of an accurate indication for where this cash is going just to maintain versus how much is actually going into growing the business as well. All right. So it's used up more money than it made there. We want to see where it's getting the rest of it. Proceeds from issuance of common stock under the employee stock purchase plan. Alright. So it's issued stock there. That's weird that it would say employee stock purchase plan. Usually they'd be paying this out if they had stock options, but obviously the options haven't been exercised, I'm assuming from that. So they've come back in from being liability that the business has to pay at some stage. And that's pretty much it. So majority of this cash is being spent back up here. Research and development, everything else, and that's before this net income. Obviously some parts of that is getting capitalized. Only a small amount, so 85 and 49 versus the, what was it, about 1.5 billion. So it's like an order of magnitude difference there. So, and look guys, I don't do any analysis or deep dive on these businesses or have a look at them before jumping on and reviewing them with you guys, just so I can show you guys that you don't need to understand the business completely and know its products, services, and everything like that before being able to have a look at the financial statements. Financial statements are the language of business. So being able to read the numbers, read through some of the words that are in here, just have that fundamental understanding really helps before wasting time on a business that's not worth it. So Datadog, is it worth having a look at further? So mastery is pretty good. The moat around the business, those kind of gross profit margins are awesome. And management wise, does look like the business is prioritizing plowing all this cash into research and development and sales and marketing. Now, is that rational? Yes, at this stage for the business, if it wants to build a moat around it and over time, the revenues would be expected to continue to grow. And eventually they can start to, in the future, they can start to wind back on this research and development and sales and marketing as they've reached more and more of their market. But over that time, the revenues will have increased and then they'll be able to take more profits from the business and some of that cash flow as well. So that does appear pretty rational to me. And this business is worth a good look at. Pardon me. However, it needs to be purchased at a reasonable price. So even if we find out this business is an exceptional business, we really need to be purchasing it at a price that is not way overvalued. And so when we get into it, and we may come up with a price that makes sense, we also need to do our deep dive. And that deep dive helps us understand what is the growth rate of the business that we would reasonably expect. But at this stage, this business has a price to earnings ratio of 698. So that is usually very, very, very high. But if we can remember that price to earnings, our earnings number here is actually this, which is 107 million. And that is an order of magnitude smaller than the net cash that the business is making, which is $1 billion. And it doesn't need to spend anywhere near that on building out property and equipment or software development costs. All that money is getting spent back upstairs in that net income, etc. All right. And at this stage, the rest of that cash has been plowed into these marketable securities, which just means that they're cash on hand. They're just trying to raise that up and go from there. All right. So I think this business is worth a good look at. Obviously, if the earnings, what they need to come up with here, if you're looking at this, is what's the value of the business, and then having a look at that price. Trying to just go off the price to earnings ratio doesn't mean much, especially on a business that's growing as rapidly as this, and one that most of the earnings already have been plowed back into the business in that R&D and the advertising part. All right. So if you enjoyed this, check out the rest of the channel. There's usually some really good stocks, usually worth a good sticky beak around. And if you're invested in Datadog or you're having a look at it, let us know in the comments. It's really good to catch up with and have a bit of a chat with some other investors that are on the journey as well. And if you enjoy this, then check out this next video because YouTube thinks you'll like it. Cheers.